Welcome back to my channel. I know you're like, you look familiar, but it's quarantine and chill, you know, but to me it's quarantine and shoot YouTube videos, what I've been trying to do. So today we are going to talk about how to get qualified for a mortgage loan if you have high student loan debt. Okay, the days are over with when student loan debt was the reason why people were not qualifying for mortgages. It's so many ways around it now. If you are the person that has 50, 60, 80, 100, 300, $500,000 in student loan debt, please watch this video so you know exactly what to do when apply for a mortgage, okay? If you are one of those people or you know someone, please keep on watching. So before I do this, you know, I need y'all to like, share, and subscribe on my channel because I do all this for free. It's just for fun, but I love YouTube and one day I want it to be what I do full time. So I need y'all to support me and my channel, but let's get right on into it. So when it comes to applying for a mortgage, what mortgage lenders look at is your debt to income ratio and give you an example. So let's say you make $60,000 a year, which ends up being, yes, $5,000 a month. So they calculate it by your gross. It doesn't matter about taxes and all that. Your debt to income ratio is monthly, not yearly. Just because you have $100,000 in debt and you only make $50,000 a year has nothing to do with anything, okay? It is how much you pay monthly. So they take the $5,000 and they do any of your revolving lines of credit. So your car payment, your credit card bills, those type of things, that's what calculates into this. So whatever you see on your credit report, that's what this is for. Any loans you have out, anything like that. Utilities, none of that is going to be calculated as far as your debt to income ratio. And most lenders like you to be under 45%, but it's best to be under 28%, okay? And that's everybody on my channel. That's what we're trying to get y'all under 28%, okay? Trying to get you less than that, but whatever. So $5,000 a month, and say I have a car payment that's $500, that gives me $4,500, and I have a $1,000 credit card payment, leaves me $3,500. They'll take this, add this all up. I put exactly how it is below, but this amount will give you this percentage will give you what your debt to income ratio is. Now, the reason why a lot of people were not applying for home mortgages at one point in time was because if your student loan payments are in forbearance or deferment, they will take 1% of what you owe. So say you get you are $100,000 in debt with your student loans, that is $1,000. Most people cannot afford that. Their debt to income ratio will be substantial. So what you have to do if this is you and you want an FHA loan, this is only if you're getting an FHA loan. That is the most popular home loan because you only have to have 3.5% down, okay? You have to go ahead and get your payments like set up. So if you're in forbearance or if you're paying like a $0 or $5 because of your income driven payments, that's not going to work with FHA because they will use 1% of your loan balance, okay? And most of the time that will knock you out. So what you do is contact Navient, Sally Mae, whoever you have, go over a payment that has a definite, this is only FHA, okay, that has a definite end payment. So you can't do income based for FHA because they don't do that. So you have to have a payment set up that at the end of, you know, 30 months or whatever, it will be paid off, or 30 years or however that works. It'll be paid off. You have to have that. So after you have qualified for that, you can go back to income. Once you qualify for your mortgage, you can go back to whatever you need to do, forbearance, deferment, whatever. But if you're getting an FHA loan and you only have 3.5% down, then you need to go ahead and set up a payment for, like, it'll be paid off at the end of this time. You need that already set up. Do not wait on your lender to do this or to screw you and do a 1%, okay? Because it's not going to work. Now, if you do a Fannie Mae or Freddie Mac payment, they do take income based student loan payments. Those programs, they require more down. That's why it's better to do FHA, because it's only 3.5%. And especially if you're coming right out of college, you don't want to have to come up with 20% down for a house. It's just almost unheard of. Some people can, some people cannot. Now, after, like I said, after you have established your mortgage and you've closed and all that, go back to whatever you need to go back to be able to afford life. So Freddie Mac is next. Now, Freddie Mac has a new program where you can do 3% down, and there's also a lot of down payment assistance programs, but we'll get on that on another video. But Freddie Mac does take income driven payments as your to be able to qualify for their home loan. So let's back this up, because I feel like it's a lot of information in one thing. But Freddie Mac and Fannie Mae does take income driven student loan payments as calculating part of your debt to income. FHA does not, but it has the lowest down payment. Okay, if you're not somewhere that can do down payment assistance, that is definitely the option that you want to do, is to negotiate how much your student loan payment is, and that's what they'll use for your debt to income ratio. You want the lowest as possible, so it does not account a lot towards that percentage. The other loan that you can get is a conventional loan. Now, a conventional loan is the best type of loan to get because it's the cheapest. It doesn't require you to have private mortgage insurance, which is like a lot. It's like most of the time it's like a couple $100s a month that adds to your mortgage payment. The only way it goes away is if you have 20% of your home paid off. If you can put 20% down, you're already getting yourself ahead, as far as you already probably have equity in your home and you don't have to carry private mortgage insurance. But that will be something that we'll go on over in another video. Right now we're just talking about student loans. And VA loans, they want you to go ahead and have a payment set up, but when it comes to VA loans, you do not have to pay a down payment. If you or your spouse or whatever is in the military, that is one of the best type of loans to have, because it does not require a down payment, and they don't, run you through a whole bunch of ringers most of the time. Like Navy Federal and USAA, they're very good to their people, so they usually approve homes rather quickly, and they're usually easy to work with when it comes to underwriting. But I know this was a lot in a video that I said really quick, which is going to end up being a shorter video. But when it comes to student loans, no more is student loans gonna stop us from getting approved for our dream homes. There's too many ways around it. There's down payment assistance as well, on top of help with negotiating your student loans with your student loan servicer. So if you have any questions, please comment below. Let me know what questions that you have, and I will see y'all next time.